Hey, good afternoon, everyone, and welcome. My name is Tim Racette, and this presentation, we're going to spend the next, 45 minutes or so talking about the E-mini futures and how you can trade them for 90 minutes a day to, develop yourself into a full-time trading career, or if you just want to be able to trade in the morning and then go off and do whether it's a day job or spend time on the golf course or riding your bike or spending time with family and friends, you've got the rest of the day to do that. So I want to thank David for hosting, as well as Anka Metcalf for hosting today's festival. And I hope everyone's enjoying all of the presentations that they've had so far. So presentations being recorded, so feel free to take notes, but you'll be able to get those recordings as well. So let's dive into kind of what we're going to be talking about. I'll give you a little bit of background about myself for those that are unfamiliar with me and my trading style, and then we can go ahead and answer. I'll try to do my best to answer some questions as we go. I'll keep my eye on that chat box. So feel free to drop questions in the chat as we're going here today. So as I started off with here, I'm mostly focusing on the E-mini futures. And what we're going to cover today are 3 simple tools that you can use to day trade. Now, you don't have to trade futures, and you don't have to necessarily day trade to be able to take away some good little nuggets of wisdom here and apply them to your own trading. So we'll talk about how I like to identify quality entry points, and how using those quality entry points, you can then get into a trade and be able to stay in those winning trades longer with some really good trade management techniques. And nothing is, proprietary to any specific platform. So regardless if you're, on Thinkorswim, Ninja, TD Ameritrade, TradeStation, whatever, you'll be able to, take away some of these principles, apply them to your day trading, apply them to swing trading, even different markets, different time frames. It really doesn't matter. So as I said, my name is Tim Racette, and I blog over at eminimind.com. As the name implies, most of my trading is revolved around the E-mini futures. I've been trading since about 2006, and most of that has been E-mini futures, but I actually got my start swing trading. And I spent some time down at the Board of Trade, had been doing some swing trading of options and things of that nature. And when I went downtown, this was kind of the early 2000s, mid 2000s, and all the guys on the trading floor, it was mostly guys, or a handful of gals down there, but most of the folks down there were working on a computer terminal, but then just going into the pits to place their trades. So those groups of traders that I met down there kind of shooed us away from making a career down in the trading floor, because they'd been down there for 30 years and seen it shrinking and drying up. So they put us in touch with some guys who were trading on the screen since the 80s, early adopters of screen trading, technical analysis, and they were trading E-mini futures. And so specifically the S&P. So they got us going with the day trading of the E-mini futures, and that's kind of how I got to this place, having some really good folks to mentor and to just kind of learn from early on. And being young with no responsibilities, no wife and kids to take care of, no seemingly very little expenses, when you're young and free, really became a big benefit to being able to learn to trade, make some mistakes, but luckily not blow up any accounts and have any catastrophic mishaps, but be able to take some calculated risks and grow my trading accounts, and then be able to kind of do this full time. So like I said, mostly E-mini futures trading. I've had the pleasure of speaking at a number of the Traders Expos and at the CME, and I've written some articles for Futures Magazine as well. When I'm not trading, I spend a lot of time outside. I am originally from the Chicagoland area, hence the connection to the Chicago Board of Trade and all of the traders down there. When I was starting as a trader, Tom Sosnoff had, it was still the early stages of Thinkorswim. This is pre TD Ameritrade, pre Charles Schwab. Sosnoff was really the kind of innovator with trading platforms at that time. Don Kaufman, Tom Sosnoff, lots of guys down in Chicago that were just visionaries and doing a lot for trading. So there were tons of opportunities to get to meet these guys, get to spend time downtown and learning the craft of trading. But I find a lot of value in getting away from the screen and being able to explore the outdoors. I spend a lot of time riding and racing my mountain bike, hiking. Now I've got a wife and a year and a half little daughter, so spend a lot of time, away from the screen doing other things. And the benefits of trading are that you can have some flexibility and being able to be super focused, disciplined, and hone in for those morning 90 minutes or so. Do a little bit of analysis or homework in the evening, and then come in the next day and just do it all over again. And leaving most of my days free is a really huge blessing. So I'm very appreciative to be able to do this, and I hope that I'm able to share a few nuggets of wisdom to you guys as well. So I'm originally from the Chicagoland area, but I am currently living in Scottsdale, Arizona. So I went to school out in Tempe, Arizona. It's a suburb of Phoenix, and then spent a little more time back in the Chicago area. And after so many winters, it's nice to be able to go somewhere warm and sunny. So can't complain about Scottsdale, and really happy to be out here. So let's talk a little bit about the routine that I use, kind of my trading style, and then we'll get into some of the more nuts and bolts. We'll walk through my trading strategy, if you will, talk about how you can spot some good trade entries, and then how you can manage those trades. So, being a technical trader is not necessarily a function of how many indicators and tools that you're looking at. So I like to keep my charts really clean. I like to keep my office clean, my desk clean, very neat and tidy. And so, clean desk, clean mind, as the saying goes. And the cleaner you can keep your trading screen, the simpler you can keep your trading strategy, the easier it's going to be to pull the trigger, to place trades, to manage trades, and just go about your trading career. If you have a ton of different indicators in the chart and 5, 6, 7 different markets and all of these tools on there that may or may not be helping you place a trade or manage a trade, then it's a really good exercise to get rid of those charts and graphs and indicators that are on top of your chart, just clogging things up. So I'm mostly looking at or placing trades and managing my trades from, they last anywhere from 2 to 20 minutes. Sometimes I get into a trade and I end up catching a runner. And so by nature of scaling out, I am able to stay in the trade for a long, long time in certain instances. Sometimes if it's a strong trend day, you can stay in all day. So the most important thing, though, circling back to the simplicity piece of it, is that less is more. So if you spend your time adding indicator after indicator, and trying to build out this very complex series of systems, it's going to lead to a lot of headaches and a lot of constant tweaking. If you can do the opposite and remove or take away so that you can clarify and simplify, that's when you'll begin to build that confidence and then develop some consistency. So I find it really important to invest in your mindset, because your mindset is what's going to carry you through those hard times. And when things aren't necessarily going your way, if you can focus on your emotional intelligence and the monetary side of trading that might stress you out, cause you to be fearful, cause you to be greedy, if you can get a really good handle on the emotional side of it, it makes it a lot easier to be more objective and more mechanical. So going outside, going on walks and bike rides and things like that, I find super valuable. You know, I've had some of my biggest light bulb moments when I'm not in front of the trading screen. And I also find reading to be super valuable. It doesn't have to be trading related, and it can just be reading, 5 minutes in the morning before you're getting ready to sit down at your computer. It just kind of stimulates the brain and allows some clarity and creativity as well. So all of those things are really helpful to, continue to progress, because in a lot of ways, trading is a very entrepreneurial, you know, endeavor, if you will. There's nobody sitting there telling you what to do that day. You have to be a self-starter, very entrepreneurial, and kind of have a holistic approach, kind of fitting everything together. Trading is just a piece of the puzzle. And if all you do is trade and zoom in on your trading, then you can kind of miss some of the other important stuff. So if you think of trading as a means to an end, and you kind of create a long-term goal and some yearly goals, not necessarily monetary goals, but more of what do you want your life to look like? What do you want your days to look like? It can help add some peace to your trading if you know that you can come in, be super focused, focus on trading the setups that present themselves. If you enter the trades that you're supposed to, then it really doesn't matter the outcome, so long as you know that you have a positive expectancy, and one trade is just one data point. You want to be looking at your trades in groups so that you don't get emotionally tied to this one really big winner or this one, or the series of stop outs that you've had. And if you can kind of design your lifestyle to fit trading into it, then you'll be able to do this for the long term. So you can free up more time and be able to do other things that you enjoy. So I want to kind of walk through a couple of the tools that I use, and then we'll put those together into what I'm using to enter my trades. And we'll go from there and talk about how I manage them from that point. So I like to use tick charts, and instead of a time-based chart, such as a 5-minute or an hourly or a daily, where you have a period of time going by, a tick chart is just a variation where it's based off of the number of transactions that occur. So I like to use a 512 tick chart. And if you have 512 transactions that take place, the candle closes, as opposed to a candle closing or a bar closing every 5 minutes on a 5-minute chart. And so this is helpful because when you have very fast forming bars, it's indicating that there's more volume, there's more transactions coming across. And when the bars are forming very slowly, that's indicating that there's not a lot of volume. So if you look at the markets during trading hours, especially at the NYSE Open, you get a lot of candles forming really quickly. There's a lot of setups and opportunities. If you look at the markets after hours, things are really slow. It's taking a long time for the market to move. There's not many setups, and there's not a whole lot to do. So you want to be active looking for setups when the market is active and there's a lot of trading activity. So it's completely derived from price. It's just a slight variation. Instead of looking at a structure of time, 1, 2, 5, 10, 15 minutes, we've got the number of transactions. And so the chart doesn't really look any different. If you didn't have an x-axis, you would know, is this a daily chart? Is this a tick chart? Is this a 1-minute chart? And there's different time frames you could use. Really small, like 144, 233. But like I said, I use the 512. On the ES and the NQ, those are pretty solid charts. For something like the YM and the 6E, I'll need to go down to like a 233 just to give a little bit more data. But for the most part, 512 is going to be a good baseline for your ES futures trading. And then the next thing I pair that with is the Heikin candlestick. So again, just a slight variation, nothing too complicated, just a slightly different way of looking at the candles. So a traditional candlestick has an open, high, low, close. With the Heikin, and so that's what this is here on the left. And we'll compare that to what the Heikin looks like. So open, high, low, close, whether you have colored bars or black and white bars, filled, unfilled, it doesn't really matter. A Heikin candlestick, instead of that open being the opening of where that candle opens, it starts at the midpoint. So you have the high, low, close, and the open is swapped out for the midpoint of the prior candle. So this is the same time frame, only on the right, you've got the Heikin candlestick. And so it helps smooth out visually and make it easier, I find, to spot the trend changes. And so that's the reason that I like the Heikin on my 512 tick chart. I really don't use it on any other time frame. Just pairing it with the 512, I find it helps clean up my chart and make it a little bit easier for me to follow along, especially when the market's moving really quickly. So with intraday trading especially, where things are moving at you really quickly, you want to be able to identify the trend or lack thereof. And so the smoothness of the Heikin can really help dictate some of that. So when you put them together, you kind of get this ultimate duo, the 512 and the Heikin, and it's a really good visual representation of what's happening in the market at kind of a very minute micro level. So it's pretty easy to spot the trend changes and when we're just chopping around. So this is a traditional candlestick chart on the left, and then on the right is the same chart, only with the Heikin on it. You can tell, the downtrend's pretty easy to spot as far as even on the traditional candlestick chart. But it's when we start going sideways that, you get these periods of like, red bar, green bars, red bars, green bars, that it does help to, it helps me stay out of choppy areas a little bit easier than if I'm just looking at the traditional candlestick. You can kind of train your eyes over the years. And so however you set your charts up, your eyes will start to, learn the patterns, learn where things are in the chart. And, if you're very experienced with looking or comfortable with looking at the traditional candlestick, and you just want to use the 512, totally fine. If you find that the Heikin adds a layer of simplicity, then by all means throw it on there. So let's talk about identifying the trend, and then we'll talk about what I'm looking for in a trade setup. So when it comes to any trading strategy, you really need to first begin with identifying, is there a trend or is there no trend? If you're trading a range bound strategy, you need to know that the market is range bound. If you're going to be trading a trending strategy, then you want to make sure that the market is giving you setups in the trending environment. So, just like a football team would kind of go back to the basics every season, blocking and tackling, basics of all the fundamentals, reviewing the structure of the game, and practicing, breaking things down and practicing the pieces separately so that they become so second nature, and you're practicing in a lower stress environment, you can really work on the mechanics. When you get in those high pressure situations, you just do it second nature. So we all know that, the market is kind of made up of stair steps and kind of an undulation of up and down. We don't just go straight up and straight down forever. We're always kind of moving up and then pulling back and then moving up and pulling back. And these series of movements are all, driven by human behavior. Even though there's a lot of computerized trading out there, there's still, humans that are interacting with the market, that are managing these systems. And so those emotions that we all know, fear and greed, kind of drive the market. Just like we've got, a boom and a bust cycle in the, in the business cycle, we have expansion and contraction. Fear and greed are the fuel for driving prices higher and then panicking and then driving them lower. So the basics of the market structure is essentially the uptrend, the downtrend, or no trend. So higher highs and higher lows, we all know, make up an uptrend. And when I say higher highs, we're just talking about, points in the market where we rise and then we pull back, and then we rise and then we pull back. That's a series of higher high and then higher low, higher high, higher low. The flip side's true with the downtrend, lower highs and lower lows. We're just making a series of new lows, and then when we bounce, we're making a lower high, and then we come down and make a lower low. And so going through, even if you just print out like a 5-minute chart of the market that you're trading and go through, if you're trading intraday, if you were swing trading, you could just print out a daily chart, going through the chart, marking it up, finding the swing highs, finding the highs that stick out, finding the lows that stick out, and then where do they relate to one another? So where is this high in relation to the prior high? Well, this guy is higher than the previous one. This one is lower than the previous one. And so it's a really good exercise to help solidify, are we in an uptrend? Are we in a downtrend? And if we're not making either of those, high after high or low after low, then we're essentially in no trend. So you can go mark the chart, with HH, HL, little acronyms. If you want to mark up your chart and practice, you can draw some trend lines or highlight through the market. And then what you begin to find is that when the market is going from a series of lower highs to higher lows, the trend has the potential to be changing. And so looking for those areas where the market is moving in one direction and then starting to change direction, or maybe we're moving up for the first 20 minutes, half hour of the morning, we get a bit of a pullback, and then we start resuming that uptrend. When you're looking at a 512 tick chart, it's a lot easier to manage your risk, get in trades, and be able to stay in the trend because you're getting in on a relatively small time frame early on in the price movement. So let's have a look at how I like to get in and then manage my trades. So we talked about those swing highs and swing lows, going through the chart, looking for higher highs, higher lows, lower highs, lower lows. And so once I get a break of a swing high or low, that's the signal that we may be starting a new trend. So if we just pretend the market's coming down, 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 and then we get this this new swing high where we break the prior high, now all of a sudden that series of lower high, lower low, lower high, lower low is broken. And we're at sort of the early stages of a new uptrend. Now, we don't know if it's going to last for 5 minutes or 5 hours, but that's the very first early stage. It's like, you know, you're on a train and you don't know exactly, you can't see the front of the train if you're in the middle or in the, you know, sitting anywhere in the inside in the cars, and you don't really know how far the station is away. But when you hear them blow the whistle, that's the early sign that we might be coming up to a station. Now, it could just be a crossing. We don't know, but we do know that they always blow the whistle when they're coming into the station. And we always know that in order for the market to start moving higher, it has to break the swing high. And so that's just kind of an early indication that we might be changing direction. So I like to use a 50% retracement as my entry, essentially letting the market pull back a little bit and using a limit order to get in, as opposed to just getting excited and chasing the market higher. A lot of times newer traders can wait for all of these indicators to line up and for the market to really be showing clear signs that the trend is up. But by that time, you know, it's too late. So, you know, if you're waiting for let's say Bitcoin to develop a strong global acceptance and everyone to be using it, well, by the time that happens, you're probably not going to see another 2,000% increase, versus when something is more in its infancy, or if you think of like a business startup or a new business, it's not clear if it's going to work out, but that's where the reward comes in. So I use a Fibonacci tool to draw the retracement. A 50% is not a Fibonacci number. I'm just using the basic tool so that I can draw the halfway back there. And so I'm just using a limit order just in front of that 50% as a way to get into the trade on a pullback with a limit order. So I'm not just throwing out, you know, any random market order. And then if we get a bounce, I'm getting in fairly early in that new trend. So once I get into a trade, I like to use with the ES a 2-point stop. So the E-mini S&P, I'm using a 2-point stop. Now, if you're trading the micros, you could do do the same thing. You're just going to have smaller risk, smaller reward. If you're trading the NASDAQ, you know, you could use like a 5 or 6-point stop to kind of keep it the equivalent. The idea is that I'm using a small enough stop where one winning trade could easily make up for a handful of losing trades. I don't want to be taking, you know, 2 ticks or 3 ticks of profit with a 2 or 3 tick stop and essentially scalping, because then I'm fighting against all the high frequency trading platforms out there, and you're just kind of really not giving yourself an opportunity to capitalize when you do catch a good, strong market move. So I use a 2-point stop, and then I also use a 3-point, what I call first target. So I cut my position in half, and I take half of the position off at 3 points. And that leaves me the second half of the position to trail. And I find that, you know, in and of itself, a 3/2 is not a bad reward to risk ratio. You know, your R multiple 1.5 is not bad. I'd like to try to get it closer to 2, but with the way the market moves, the ES in particular, if you try and do an all in, all out where you just have one exit point, a lot of times what happens is you can close out the trade for a point and it ends up going to be a big runner. And you say, well, shoot, next time I'm gonna trail my stop. So what do? The next time? You trail your stop. And what does it do? It goes exactly 2 points and then turns around on you. And so you're always kind of doing what you wish you would have done on the very last trade. So this way, you don't end up having to think about it. You can just have that target out there and still have half the position to trail. So I always recommend to people, if you don't have the account size to trade 2 regular ES contracts, now that the micros are out there, go ahead and practice by trading 2 or 4 micro contracts so that you can develop the skills to have multiple exit points. And then you can go, work your way back up to the regular ES, make 50 trades on sim, and then make 50 trades on the micros, assess your stats, your winning percentage, your R multiple, your expectancy, just kind of your basic numbers, seeing if you're profitable over 50 trades. If you make some tweaks in the micros after 50 trades, make another 50 trades, and then see how your numbers work out. And then you can go to the regular ES, make 50 trades. Don't make any major adjustments in those 50 trades, just execute as best you can, and then go back and look at the numbers. If you want to make it 25 trades to, before you make some adjustments, okay. But the idea is you don't want to be looking at 1 or 2 trades in and of themselves. So 2-point stop, 3-point first target. And then the second half of the position, I like to trail. So I've got a couple of different ways that I trail my stop, but they're all pretty basic. And they're often market dependent on how quickly the market is moving. So even if up until this point, you're like, well, I got my own strategy, I'm really comfortable trading it, but I just don't know when to get out. I get in trades, I have no problem executing, no problem, throwing my stop out there, but I'm not sure how to, stay in winners and stay in winners longer and cut my losses. So here's 3 techniques that you could use, and you could even use this in the daily chart as well. So the first option is to use the Fibonacci tool and trail the 61.8%. So essentially, if the market pulls back more than roughly 2/3, then you're going to get out. So your stop would be below that 61.8. And so if the market makes a leg higher and pulls back, you could draw up from low to high and then draw up the next low to high and continue to do that in the series and put your stop underneath the 61.8 and trail your stop so long as the market's continuing that trend. But sometimes we don't get a very big pullback, and your stop might, price might be 5, 6, 7 points away from your stop. And it gets to the point where it's like, well, I don't want to give up 6 points. I could close out of the trade and put on a new trade at with a 2-point stop and have less risk. So what you can do is simply trail swing highs and swing lows. So a swing low would be every little pullback that the market gives you. So if we get long at the 50%, market makes a new high, pulls back, or in this case, kind of a double top, pulls back. We get one little red candle, that's all. And then the market goes higher. Well, I can move my stop just a tick or 2 underneath that candle and then let it go higher. And once we get another little pullback, and then we bounce into new highs, I can move my stop up to the next swing low and then pull back and move it up underneath the next swing low. And I can do that until the market breaks a swing low, which is a signal of a potential change in trend. On the daily chart, this is fantastic. If you're swing trading, you can get in the trade, you can put your stop below the current swing low, and then you can just trail swing lows if you're long. If you're short, you're trailing swing highs. But it's a really good way to get in the trade and then just kind of methodically manage your stop, giving a little bit of room, but also locking in a decent amount of profit on the way. And then the third option, what do you do if you get a little lucky, you get in the trade, and the thing just starts to rip? Well, rather than just hitting the flatten button or closing out of the trade at market, wherever price is, what I like to do is trail each candle. And on a daily chart, this is pretty easy. You've got all day, the candle closes. At the start of the next day, you can just put your stop below the daily candle and continue to do that on the way up. If you're short, you can just put your stop a few cents above the high of the daily candle and trail it on the way down. For an intraday chart, sometimes things move really fast. And so I just got, my mouse, my cursor on the trade ladder, and I just I bring it over to the chart, and I kind of eyeball where the low is, and I can see my y-axis, what the price is, and I just keep dragging my price up on my trade ladder. Some charts, like Thinkorswim, you can link them together, so you could see your stop on your chart and then drag up the price right on your chart. But the idea is just that, every single one of these candles makes a higher low. Like, we do not break the prior candle's low on this entire run up until here. So rather than freaking out and just closing out of the position down here because it started to move quickly, at the very least, get super aggressive with your stop, put it 2 ticks below each candle, and if it runs another 5 points, you might catch 4 of those 5 points. So it's a really helpful way to manage a position methodically, even if things start to, move really, really quickly and, go in your favor. It's easy to take a stop out, and your order's in there when you place the trade. So if it, ding, hits your fill and then just rips right through, ding, you're stopped out. And there's not much to do, but having a plan for what you're going to do if the market does go in your favor is, in some cases, just as important as having that fail stop in place. So to kind of tie everything together, while you don't have to use a tick chart and you don't have to use a Heikin Ashi candlestick, it does help me give me a better visual and keep the charts fairly clean, especially those smaller time frames. They can end up being a lot of what looks like a lot of noise. So pairing those two together, I find pretty beneficial. And then if you can start by identifying the trend, it's easier to identify where the trend is changing. If you know that you're in an uptrend, it's easy to identify the prior swing low. And when you break that level, identify that we may be in the early stages of a new trend in the other direction. I like to look for, larger support and resistance levels. I like to pay attention when I'm intraday trading to the prior day's high-low close. Lots of times those end up being some key levels that are worth placing trades around those areas. And then for the entry itself, waiting for a swing high or low to break is really critical. So leaning on those swing highs and swing lows before placing a trade is a good way to help filter out your trades. And the NYSE open, so 9:30 Eastern, it can get really dicey right at the open. So I like to wait the first 15 minutes and just kind of make some observations, maybe draw up some setups, identify the high and low, but I'm not placing any trades until about that 15-minute mark after the bell. And then I'll go for, hour and a half. And if I'm in a trade, I'll continue to trail it. But if it's, 11:30 Eastern, I'm gonna, and I'm not in any trades, I'm gonna shut it down and call it a day. If I'm in a swing trade or managing some kind of longer term position, I do all that at the close, like in the last 10 minutes of the day. So I set a little alarm on my phone and come check on things at the close, and I can manage that stuff then. Then I like to enter using the 50% retracement on the 512 tick chart. And then once I'm in a trade, that 2-point initial stop, 3-point first target, cutting the position in half. So if you're trading, 2 contracts, it's just 1 and 1. But if you're getting to like 4 or 6 contracts, just divide it up in half, and then the part that you're trailing, you could break that up again, but I like to keep things as simple as possible. And so I don't really get too fancy with my exits. But then the key here is just being able to trail that second half of the position. Maybe 15% of the time you'll catch a 10, 15 point runner, and that really adds to the P&L, and starts to pad your P&L to the positive in a big way. So I want to thank everyone for tuning in. If you head over to eMoneyMind.com, you can go to eMoneyMind.com/success-hacks, and there's a handful of other trading related and life hacks that I've found super helpful. I've got them listed there. If you have specific questions related to the ES or just your trading or mountain biking, you can always email me, tim@eMoneyMind.com. And I hope everyone has a great rest of your day. I think I hit a handful of the questions in there, and if anyone does have more questions, you can always shoot me an email. Happy to chat more. So thanks for having me, David, and I appreciate everyone's time.